Hey everyone, welcome to video number 5. This is probably one of my favorite things to go over, and this is the building blocks of how you're going to follow price up and down. So here I want to go over key levels and order flow. First, order flow. It's very simple to follow, simple concept. Down close candles, like these black ones, when their highs get closed above, that's significant to bullish order flow. So down close candles, highs being closed above, bullish order flow. Up close candles, lows being closed below, bearish order flow. Now, just because we're in bullish and bearish order flow doesn't mean we're completely reversing. Like here, this up close candles low gets closed below. That means we are on sell side delivery because we had a CSD or a change in the state of delivery to the sell side, but we're still in the retracement portion of a bullish fractal. So understanding the delivery is still the most important part. Where order flow comes in, it lets us know when we're stopping expansions, basically. And we could either be retracing, reversing, or consolidating. So when we have a bullish expansion in bullish order flow, up close candles are going to form. When up close candles stop forming in a bullish expansion, something's off. We should not have down close candles, especially closing below up close candles lows in a bullish expansion. So that means we are either accumulating or consolidating, reversing, or we could possibly be retracing, or we could possibly be reversing. Same thing with down close candles. Consecutive down close candles is a bearish expansion. Once we stop doing that, we're saying something's off. We need to chill for a minute, and then we read the highs and the lows. So simply put, that's bullish and bearish order flow and when to understand which one we are in. Like I said, still need to understand where we're at in the order of delivery and what the market is running on, higher time frame down to your lower time frame. So, order of delivery. Next, key levels. What is a key level? Key levels are significant price points. The algo will reference where initial buying and selling was done or created through fair valuation. So, initial buying and initial selling can be referenced in a few different ways. The start of time, so like 4 a.m. here, you'll learn about 8 a.m. here, two starts to algorithmic delivery. Those are going to be referenced because that's the start of buying and selling. On the other hand, when you have a significant price move or energetic price move, the origin of that sell or the origin of that buy is going to be a high probability key level because that's where the initial orders were put in to push price in certain directions, especially if we're breaking structure, which is 3 candle swing highs and lows. So those price levels will be referenced along with these other key levels we're going to go over. But before I go over the key levels, you need to understand how to read them and what they mean. First, we need to know, is the key level bullish or bearish? So we know to look for a bullish fractal or a bearish fractal when we get there. Bullish fractals will act as support. So here's the opening price. We closed above it. We're coming back in here. Now that we are above the key level, we're looking for a bullish fractal that we can buy from. So if we understand when we're coming back to this key level that this is a bullish key level, even though it seems rudimentary, our mind will switch to, instead of looking at all this candlesticks moving up and down, we'll understand that this key level should give me a bullish fractal. So all I'm looking for is bullish order of delivery. Sell side, buy side, retracement, expand. Fractal delivery on a key level. So understanding if the key level is bullish or bearish is extremely important, especially when we start doing the 1 hour down to the 5 minute, down to the 1 minute. 1 hour key level. If you're heading towards a 1 hour key level, but you're on the 1 minute and you got all these candlesticks moving all over the place, it's easy to get lost in it unless you understand that that level is a bearish or a bullish key level. If a 1 minute chart's heading up to a 1 hour bearish key level, we don't have to worry about all the craziness. We can just look for a bearish fractal or to bearishness being invalidated in the form of directional gaps, which we're going to go over in a minute. So that goes into, are we buying or selling the level? That's what true support and resistance is, coming from algorithmic key levels and how we're trading there. The only time we don't expect us to go back to a key level is when we have a gap. It's called gap risk. So this key level we're going to go over in a minute. It's the OGC. The OG is going to be the origin of the expansions. The OGC is the origin confirmation, which is always going to be the second candle in an expansion. That confirms the expansion. So 1 candle, 2 candle. The opening prices of both of those are going to be significant. We want those acting as support to frame bullishness. If those are getting closed below, especially the origin of an expansion, then we expect it to act as resistance and we go lower. Since we have a gap here, which is a directional gap, we don't necessarily need it to come down to that key level. Gap risk, gaps give us direction. So if we're respecting this gap, which means we're failing to close below it, this key level doesn't need to be hit. Again, go over that more in a minute. So reading key levels. There is 3 ways that we read key levels. Key level, we'll say this is a bearish key level. When we are trading up to it, we want bearish fractals to form around that level. So you're going to get your orders of delivery around there. They form in different ways. An easier way to read it is to see what we're doing. If we are wicking this level and we're failing to put bodies above it, that's an indication that we're selling this bearish key level because we're scooping up or distributing orders in this key level or liquidity pool on either a higher time frame or the time frame you're on. If we fail to put bodies above it, then we're selling that level. Inversely, if it is a bullish key level and we are wicking it, oh, that's the wrong one, then we are buying the key level. So if we head up to the key level, this is giving enough confirmation, we can buy or sell the next candle. Or we can wait for this to get wicked, which says we're buying the level. Down close candles high gets closed above, which signifies bullish order flow resuming. At that point in time, we wait for fair valuation to get back down to a discounted portion of this price leg, and then we enter. So one is an early entry, one's a confirmed entry. This is one way to read the key level. The next way is to get body closes on the level. When we have a body close on the level, that can signify that we may be doing the opposite. So if this is coming up to a bearish key level and we're closing with an up close candle, we could be buying that level. So in this case, we need to wait for more information. Is the next candle just going to continue going up? Or if we're going to engage, we need the next candle to give me confirmation that we're going lower in the form of an up candle's low being closed below. This forms an order block on the key level. Up candle closing on the key level, opening price close below and low, validated. Now we can take the trade after we come back to fair valuation. Same here. Order block, fair valuation. and we go. When we're wicking, we don't necessarily need this validation. When we're closing, we want to make sure that we're going to continue bullish or bearish order flow. So wicking or creating an order block on the level, two ways to read them. The next one is if we get body close, I know the drawings aren't really to scale, but you get the picture. If we create a gap on the level, so this can be a directional gap or a DG. Directional gaps, you guessed it, give us direction. So if we create a gap on a key level, what we need to focus on is how we trade back inside of this gap. If we trade back inside of the gap, respect the equilibrium, and fail to close below, then that is a high probability continuation trade in this direction. If we close below it, trade back in, and now respect the equilibrium on the other side. So if we're either using it as support or as resistance, this can be a good indication of a reversal. So being aware of what's happening at your key level gives you your direction and your order flow. So let's go back down and go over a lot of these key levels now and see how we are acting there. So when you're inside of this fractal and you have the understanding of how the market should move, we need to know where the key levels are forming inside of this fractal so we can engage with price. So we can keep following price. So we know when price is invalidated. If our bullish bias is invalidated, we need to trade accordingly. And this keeps us calm in the market because we're trading the understanding of what should happen at a certain level. And we know when it gets invalidated and we can just calmly either walk away or switch your bias. But it's all going to be through these principles. How are we reading key levels? So we have an accumulation, manipulation, expansion, retracement, expansion. This fractal is playing out. Inside of this fractal, you've got key levels that you can focus on to help you get price to where it needs to go. After we close in here, this is a directional gap. So DG, directional gap, these are formed below 3 candle swing highs and lows. 3 candle swing highs is a candle or low as a low. To the left is going to be a higher low, and to the right is going to be a higher low. So 3 candle formation. This is also a range limiter, the bottom of a range, and then 3 candle swing high would be the high of the range. So high, higher high, lower high, 3 candle swing high. Closing above and below these is where directional gaps and true order blocks are going to form. So high probability is this candle that closes below here gives us a DG, which is a directional gap. Just like we were saying up there, if we have a gap forming at a key level, we want to know how we're trading at its equilibrium. If we can close it in and close the gap, then we are shifting the market to the other side. If we're not, we're using it as resistance, and then we're going lower. This is also an order block candidate. It's a candidate until its opening price gets closed above. So, opening price of the candle that closes below the 3 candle swing low gets validated when this up close candle closes above its open. At that point in time, this becomes a bullish order block. It should act as support for price because a bullish order block is a bullish key level, so we're looking for bullish reactions from it. Inside of These expansions here, following the order of delivery, failure swing, I've gone over quite a few times. The failure swing that is in the lower half of an expansion for a bullish expansion or the higher half in a bearish expansion is going to be the highest probability liquidity. This is a gap. So we are expecting bullish action from this bullish expansion. Here's our key level, failure swing. If you notice, this down candle closes below this 3-candle swing low, which means it's an order block candidate. We close above its opening price. So this becomes a valid bullish key level. And inside of this order block, we have a gap. So now we've got a cluster of key levels, which is always going to be more confirmation for what we want to see. Bullish order block, bullish key level, failure swing of sell side. We always buy sell side liquidity inside of a bullish gap. So we're looking for bullish reactions here. As we come down, we have a candle body that closes on the level. What does that mean? Just like we went through up here, we need to wait for more information because it can continue closing down. After this candle closes above it, perfect. We leave a failure swing. We wait for fair valuation. Down close candle, high closed above. We wait for fair valuation. We enter, and that's our trade. So that's the second way that I talked about reading a key level. Failure swing, swept. Since this failure swing, it's got a little bit of a close on it. So down close candles, high closed above, fair valuation and buy. Same thing. Because we're confirmed bullish, we're looking for bullish reactions from these key levels. So I want to finish up with bags and DGs. So directional, when there's one gap, that's your directional gap. When there's more than one gap, 2, 3, 4, 5, we focus on the first two created. So one gap, two gap. The first one is a breakaway gap. That one we don't want to get touched. The second one is your directional gap. Especially in this case, we close above a 3-candle swing high, coming off of a bullish reaction from a key level, which is our OG. And then you've got our OGC, which is the expansion confirmation, using it as support, expansion through the high, bullish, directional gap, failure swing. We sweep it inside of the gap. We're respecting it. So key level, gap above it, respecting the top side, bullishness continues. This is how you find key levels and you follow order flow through these type of fractals. So as long as you keep it simple with the understanding that all key levels can be read in those 3 ways, we know how to understand and we know how to tell if it's bullish or bearish and if it's being invalidated. So if this gap was closed below, we need more information. We've got a failure swing and then we've got an expansion block, which is the last down close candle before a swing that closes above a 3-candle swing high or low. Opening price, key level, failure swing. It could buy from there, but I may want to wait till it gets back above this directional gap because we shouldn't be closing these in bullish order flow. This is the origin of this expansion. This is the OG, this is the OGC. This bullish bias gets invalidated when we close above the origin here, or close below. We close below there, it's going to act as resistance, and then we're going to go lower, hitting some more key levels. So we stay calm and we read what's happening through all these key levels. Expansion block, last up close candle before a swing that closes below structure, which is your 3 candle swing low. This price should show bearishness, but we've already confirmed bullishness here. So this expansion is being rejected by these key levels, but it's into bullish order flow. So we need to understand this is a retracement at a significant key level. Once we close above it and below it, we're consolidating on the level, but we're respecting the top side here. So now our direction is confirmed. We're respecting the support of the key levels, which means bullish order flow is still in play. So even though it's not expanding yet and it's going up and down and you're in the trade here and you're kind of waiting for it to move, you don't have to get too worried because you have the key levels that are supporting price. And we know what that means. If they're supporting price, bullish order flow is still in play. Until they start getting closed below, we don't have to worry and we can hang out in this trade based off of the understanding that we have with our key levels. So as it's moving up, you are looking left, you're seeing what's created, you're seeing what you're closing above, and then you're following order flow to suit. The other fractal that we look at is more of the way the market just keeps flowing, the ebbs and flows of the market. So as we're expanding up, we're respecting and breaking highs. Once we start breaking the origins of those expansions, and you don't even need candlesticks to see this, because it's an understanding. These are all origins of expansions, and those are key levels. If we are breaking those, just like right here, if we started breaking that, it's going to act as resistance. So the left side of the chart supports the right side of the chart. This fractal shows up for reversals, retracements. It's going to book the market up and down with the ebbs and flows of the market. With the understanding of the key levels that we have, we know when things are getting invalidated. As this market's moving up, you're going to have gaps forming. You're going to have OGCs, expansion confirmations. You're going to have a lot of ways to read the market and to see if we're going to continue or not. These gaps, directional gaps, breakaway gaps are going to keep forming. And that's where we're going to be watching price to see if we're respecting it or not. And we stay calm. We understand that we have an order of delivery, we have expansions, and we need retracements. Retracements are a natural part of the algorithmic process. It needs to happen. So we don't get worried that we're completely reversing if we're in the buy right here. All we need to do is read how we react at our significant key levels that we have on our chart. Are we wicking? Are we closing? Are we creating a gap? Nice and simple. And then we follow order flow. So it'll all come together over time, especially in the live educational classes when we go through the each day. I go through this stuff. I hammer it in every single class. We're going to see how we moved through the day. And then I'll go through some live trades in Asia if I have time and stuff like that based off of movement and respecting this stuff. So we're going to add some more fuel to this fire. Study this one a lot. Go through your charts and put the key levels on each day. So 8 a.m., what happens after 8 a.m., where your key levels form, where your directional gaps form. Are we respecting them? The reactions from it. You're going to see how this stuff just works. It just happens all the time. Here's your expansion. You have your OG. You have your OGC, expansion confirmation. Pulling those levels over, you can see we're wicking this level, which means we're selling this level. This is actually a trade that I took today, right here. took this whole sell, and then this buy, and this buy. Um, all based off of what we're learning here, and then what you're going to learn. So simple concepts, but it's things that you need to be aware of, and you need to trade the understanding of it. So we look left, we see our key levels, we read the key level, and then we realize we are selling where the previous selling was done, which means we're going to be looking for failure swings and previous lows. Nice and simple. One last principle that I'm going to go over here really quick is expansions. So if you have an expansion that fails to break a high, that becomes internal liquidity. That's where retracements are permitted, and we could be taking lows. But this is a bullish expansion. It confirmed bullish. So when we retrace here, since this expansion failed to take out this low in bullish order flow, this high is your first target. So when you're trading this this retracement, you're targeting fair value for buying. In bullish order flow, when you're buying in fair value for buying, you're targeting previous highs. Because in bullish order flow, previous highs will get traded above, previous lows will act as support. So if you're following your confirmation of direction and your order flow, then if you're selling here and you're expecting this low to go and you're getting confused and you're like, well, I just want to hold it, maybe it's going to go lower. You need to bring yourself back to where are we in the order delivery? It's a retracement. What do retracements seek? They're going to seek imbalances and internal liquidity and fair value. So then you can trade this accordingly to sell, to then buy, to take out this high. Very important. So expansion, we have a retracement. Since it's a bullish expansion, the retracement shouldn't take this low. So when it's respecting this here, then our first target is going to be this high. Because in bullish order flow, we should respect key levels, not take this low, and we should take this high. And it's all based off the understanding of order flow and order of delivery. So go through a lot of price action like that constantly. Look for the key levels, look at the reactions off of them. And like I said, go through this lesson quite a bit. I know it was longer, but it's super important. So thank you, and I will see you on the next one.